Hello, my name is Doug Greenberg, and I'm the president of Pacific Northwest Advisory. On a monthly basis, I attempt to explain using a variety of charts and graphs what's occurring in the economy and in the markets in a video. Thank you for taking the time to watch. I like to start with headlines. The biggest headline over the past week has been the collapse of Silicon Valley Bank, which is the second largest bank failure in US history. In my opinion, the bank failed because of mismatches in their asset and liabilities that were exacerbated by the sharp increase in interest rates over the past year. On Sunday nights, I get a research report from Morgan Stanley. What's next in global markets? It's complicated. Well, I would tend to agree. In my 30 years as a financial advisor and in working in financial markets, I will also agree it is very complicated currently. What brings us great joy, of course, is March Madness. If you're a basketball fan, have you filled out your bracket? I love the headlines 13 most dangerous teams in March Madness. And if you haven't heard of ChatGPT, I would encourage and recommend that you go Google that and test it out. It's quite extraordinary. It has its limitations and has a lot to learn, little tongue in cheek humor, but I think you will find it fascinating and certainly worth your time to check out. Um, when we're in times of turmoil in the economies and the markets, I find that clients like to have their financial plan updated. If you don't have a financial plan, get one. I have found in working with clients that during times of stress and turmoil, going back to that original financial plan, updating the data, and rerunning, potentially with some other what if scenarios, allows and gives the client comfort in knowing that the hiccups that we're experiencing over the course of the last 10 days will not ruin their plan or their goal setting. And so if you haven't done a financial plan, please do one. And if you do have one with your advisor, please go and have it updated. I find that financial planning is incredibly beneficial for the client, but also very beneficial for me as it allows me to learn a lot about a client, not only the data, but also the emotions around investing. March 8th was International Women's Day. And I wanted to take a moment to share this slide to show how women are strong investors who do a number of things that lead to better outcomes. They trade less, they do their research, and that gives them, again, according to the study, an outperformance above men and their returns of about 1.8%. Currently, given what's occurred in the banking sector, we have extreme fear floating through the markets. The top chart shows a fear and greed chart that CNN compiles. And you can see the first red is in September of 22. We hit a low in October. And it's very similar to the point that we're hitting now in terms of a low in that extreme fear number. This has bounced up given what's occurred today in the markets. But when we look at the VIX or we look at market volatility, we can see it's elevated and it has moved sharply. And this is a good indicator of the volatility of the markets over the next 30 days. The Consumer Price Index report was released, and one of the things that among all the numbers was this line: services less rent of shelter. This category is incredibly important to Chairman Powell, and it's a figure that he's focused on reducing. Currently, it shows a year over year change of 6.9% in services less rent of shelter. And if the goal of or the mandate of the Federal Reserve to bring inflation back down to a range of 2%, This number has to come down dramatically. This number is high because of wage pressures, because of a tight labor market. When we look at some consumer indicators, just briefly touching on this, we can see that consumers have run out of the extra cash that they had in their bank account because of the COVID payments. And so we are seeing them, due to inflation and spending habits that were created during COVID, begin to come close to using up their credit exposure. We also see it with respect to mortgages and consumer credit. And what's driving the inflation that we spoke about a minute ago in services is the year over year change in both job stayers and job changers. We do see and are experiencing a slight decline in the year over year change, still pretty high at 14%. And when ADP put this report out, it shows that in February, we saw a fairly substantial increase for job stayers in their pay. And this is what is one of the factors that's keeping inflation high. This chart, this correlation between Fed funds rate and the unemployment rate, is very telling. Interest rate hikes pass through to the labor market by reducing aggregate demand and business investment, by increasing borrowing costs and tighter financial conditions. As businesses pull back, slower hiring will reduce the upward pressure on wages, that wage inflation. It reduces input costs for companies and weighs on workers' income. As a result, there is a positive correlation between the Fed funds rate set by the Fed and the unemployment rate. However, this pass-through process takes time, and with the historical relationship suggesting it takes up to 24 months before the full effects of interest rate changes are felt in the labor market. Here's where we are today. That strongest correlation is set to occur another 12 months out. When we look at the current um, employment data, we can see that the initial claims for unemployment insurance is pretty stagnant. We're not seeing big jumps. We're not seeing big layoffs. We're not seeing big shutdowns. The employment rate has been stable. Our non-farm payrolls month over month spiked and came down last month, but it's still very strong. Our job openings are still high as well. And it'll be interesting to see as we progress through these months how these indicators will react. A big question that I get from clients is this value versus growth, and how will the Fed tightening affect value versus growth and style cycles? And so in the upper left-hand chart, we can see that as we move away from the end of the Fed tightening cycle, value does better than growth. And so we want to focus on, as we move through this process, at some point, the Fed will stop hiking rates. And over the past 5 cycles, we've seen value outperform growth. In the bottom chart, when we look at a rolling 3-year annualized price return difference between value and growth, we know that growth has had a very long run, and that return between value and growth, um, there are periods when value outperforms and there's periods when growth outperforms. When we look at, though, year to date through the first 2 months of this year, we can see that the returns for large, mid, and small growth have all been better than any of the value categories. Now, that may be in tune as investors move away from banking, away from energy, and put the money into technology, large growth companies that fell tremendously last year and that are clearly with some low prices. But we don't see that continuing. Because again, when we look at valuations over a 20-year period, large cap growth is 22% above its 20-year average. Still too high. And even in the value cohort, we'd like to see these, I would like to see these lower um, as a way to entice investors to come in. Now, we may see a flush out, which would lower the PE numbers and would give us more comfort in increasing allocations to U.S. equities. When we step back and we look at the globe and we focus on the three markets, the US, emerging markets, and then developed markets without the US involved, we can see that those price earning ratios are quite a bit lower than the US, meaning that for every dollar that we invest, we are taking less risk from a valuation perspective. Again, another reason why I chose to move dollars out of the US markets and into emerging markets and developed markets ex US. We recognize that there are periods in which the US does better, and there's periods of when the international equity does better. And we are coming to the end, if you will, of the US outperformance with an expectation that the international will begin to outperform. We need to see some more data along those lines. But for instance, in China, I have an expectation that their country GDP will grow by 6% this year. That's their target and their goal. Their consumer is stronger than our consumer. They're just on a different timeline than the US consumer. So you could easily see China reopening, fueling emerging market GDP as China looks to grow their economy internally, make products for their citizens rather than making things for other countries to buy. This consumer potential is massive in China. They're sitting on the Chinese households are sitting on some $2.6 trillion of bank deposits, primarily because they couldn't spend locked up in their homes. Again, a similar trajectory that the US went through. This is just happening later. And so when we look at the line of expenditures, and we recognize that we're off target because of what occurred in 2020 lockdown and in 2022, my anticipation is that we will revert to the mean, which will drive the Chinese economy on the go forward, or through at least 2023 and part of 2024. And then finally, given the news about the banking sector, I do want to touch on something that I am focused on and will continue to watch. In '07 and '08, in the aftermath of '07 and '08, the Federal Reserve and the Treasury came out with stress tests. And those stress tests were to be done on banks that had 50 billion or more in assets. When the Trump administration came in, they changed that number to 250 billion in assets that needed to go through the stress test. Silicon Valley Bank, even though it was the 18th largest bank, had about 180 billion, and so they were not subject to this stress test. It's my opinion, and in my experience, that the focus on the lending institutions on the go forward will need to be on the commercial and industrial lending that they have done. COVID has changed how we work. COVID has changed the value of commercial properties because typically they're less filled now. And so when the leases come about, they'll be leasing less of a building, there'll be less income for that building, the valuation on that building will come down, and the question remains, is the loan properly collateralized as the value of that building declines? And how does that get worked out and when? And so when we look at The banks that do the business and commercial industrial lending, 50% of them are less than 250 billion in assets, meaning at this current time, they're not subject to stress tests. We'll see what regulations come out of the SVB situation, but again, it's something that is on the radar and paying particularly close attention to. Thank you for taking the time to watch, and if you have any questions, please let me know. Thank you.